Thanks everybody for coming today. My name's Eric Hassert. I work at the FARMroots team for GrowNYC. We are a nonprofit, environmental nonprofit that is based out of New York City that runs several different farmers markets throughout the city, working with about 200 or so farms throughout the Northeast. And we have been working on a project for the last year or so, helping our New York State growers expand their wholesale operations. And so in doing so, we met kitchen table consultants while attending one of their workshops in Pennsylvania. And so we were lucky enough to learn a lot from them at that workshop, which was also working with farms on how to scale up and get ready for selling to institutions. And we did a workshop out in Hyde Park with them for a couple of days. And this is a continuation of that work. We've already done a crop costing tool that we showcased last month, which if anyone's interested, we'd be happy to share that with you and share the recording with you so you can better understand what your production costs are and how to set pricing. And then today what we're going to be going over is how to set up your chart of accounts for an agricultural business. And so we have Rebecca Frimmer with us today, who is works with Kitchen Table Consultants. She's their West Coast Entrepreneur in Residence, I believe is her title. And she specializes in doing business planning, financial analysis, sales coaching, operations management, feasibility studies, a whole plethora of services she has to offer. And we were really impressed when we saw Rebecca give her presentations in Pennsylvania. So we're really happy to have her today with us explaining how to set up your chart of accounts. And she works with a variety of different organizations on a variety of different projects. So if anyone is interested in digging in a little bit deeper with Rebecca or Kitchen Table, there's going to be some additional consulting services free of charge for about 4 of our farms that are attending today. So feel free to shoot me a note or ask any questions, shoot me an email if you guys are interested in getting connected with Rebecca and utilizing some of her awesome services. So without further ado, I'll let Rebecca take it from here.
Okay. Thank you so much, Eric. I appreciate the introduction. Just a tiny bit of housekeeping before we get started. I can see that just got a strange echo all of a sudden. Okay, I think it's good now. So anyone who has questions can type them in the chat. Eric's going to be monitoring the chat as we go through. I will not, because it's really hard to present and read the chat at the same time. So Eric's going to stop me when we have a critical mass of questions and we'll answer them. Otherwise, we'll hold them until the end. And I'm just going to go ahead and get started here. You can also privately send a message to Eric if you have a question for him that you don't want to post to the group for some reason. But all questions are good questions. I'm sure if you have that question, other people have it too. So don't be nervous and just go ahead and pop it in there. No judgment. We're all just trying to learn. So let me share my screen with you and go full screen here. Okay, so today we're going to talk about the chart of accounts, how to organize it, but also why it matters. I mean, some of you may be sitting in this webinar going, what is the chart of accounts? And that's okay. We'll talk about the beginning all the way through. So Eric described us briefly. Kitchen Table Consultants, we're a collective of entrepreneurs, hence the silly title, Entrepreneur in Residence. But it's true, we've all been in your shoes as business owners trying to figure out how to make it work. And so we're all using that knowledge here at KTC today to help passionate farmers and food system professionals, economic development groups, build lasting and profitable locally focused businesses. And these are some of the services that we do and offer, which Eric already kind of told you a little bit about. And we operate by 4 tenets that we've walked a mile in your shoes. As entrepreneurs, we understand what it feels like to have to run your business even when times are tight, that we will just be honest with you about what's going on in your business and what we see, that we roll up our sleeves and work alongside you, and that we're committed to providing more value than the cost of our services. So let's dive right into the content today. We're talking about chart of accounts. What is it and why does it matter? So when we are doing financial analysis on our own business, we have a number of reports that we use from an accounting system. We use a profit and loss statement, we use a balance sheet, and we may also use a statement of cash flow or some kind of cash flow projection tool. The chart of accounts is the organization system that sits behind all of those reports. So it is categories and basically buckets that you're going to put information in. And then the database of your accounting system or your spreadsheet tool or whatever you're using will organize all of your expenses and revenues. And then on the balance sheet side, your assets, liabilities, and equity into those reports that you need to see to evaluate your business. But like anything else, the chart of accounts is a tool in and of itself. So if we organize in a way that is proactive to having better data and understanding our business on a deeper level, then those reports are far more useful to us than if we just go with default mode in these systems, because it can be really hard to digest too many numbers at once. Like our brains and our eyes just can't take all that in at once. So our theory with the chart of accounts at KTC, our basic theory, is that we organize the chart of accounts in a 7 numbers format. If we do this, then when we view the report at a high level, we can see specifically 7 numbers and have a much easier time seeing how those numbers change or how trends are moving over time. So these are the 7 numbers that we focus on for the profit and loss statement and the accounts within. Income, cost of goods sold, and then you can see these 5 categories of general expenses below. Labor, general administrative, operating, fixed, and one-time expenses. Don't worry, we're going to go deeper into this and talk about this quite a bit more, but this is the starting point. So the chart of accounts provides a complete listing of every account in an accounting system. In our QuickBooks file, we have a demonstration account that's called eSpend Farm. And so a lot of information throughout this presentation is from our demonstration account. What you can see here is 2 columns of all of the items in the chart of accounts. And you can see there's a lot more than 7 numbers here, clearly. So the point that I want to make is that we have parent categories, and then we have some indented subcategories, and this is the profit and loss categories for the chart of accounts. So when we look to see those 7 numbers, we can collapse the sub-accounts down so we only see the 7 numbers in a collapsed report. But really what we would look for is trends and or meeting our budgeting goals in those specific categories. And then when something is out of scope with our expectation, we can pop it open and look at the detail within. So we're not starting with whatever this is, 50 different numbers that we're trying to track. We're starting with 7, and then we're opening up and going deeper when we need a higher level of information. So a little bit more about this structure. So the first 2 of the 7 numbers are the income and the cost of goods sold. The calculation that we get from those is gross profit, right? Income minus cost of goods sold is gross profit. Gross profit tells us how much money is left after the direct cost of goods sold to cover all of the rest of the expenses in the business, including the profit and or the owner's pay, or both, really, because they're not the same thing. So then we have our 5 categories of general expenses, and when we subtract those down from the gross profit, we get net profit. So there are a couple other numbers that we're calculating out here, and what I want to stress is that you don't need a category for every little thing. I've seen chart of accounts for farms that have like 150 accounts in their chart of accounts and their profit and loss statement. That's just so much information to digest. How much detail do you really need? There's a lot of other ways to get a higher level of detail if you really need to dig in, like using your memos appropriately and being able to sort your transactions by vendor or by notes in the memo, things of that nature. So just think about what you really do need a category for so that you can see trends. When we organize our chart of accounts, of course, there's going to be subcategories, as I mentioned. Here are a couple of examples of putting subcategories under parent accounts. So, for example, general and administrative is a pretty broad category. It includes all of the things that you need to keep your office running. It also includes all of your marketing expenses, and you may even have like 2 levels of subcategories. You may have general administrative, and then like office supplies, postage, professional fees, meals and entertainment, things of that nature. And then marketing expenses may have even more beneath it. You may choose to separate out website, advertising expenses, but just think about how granular you really need to go in those accounts, what you really need to see in your profit and loss, right? Because you can always look at transaction detail in addition to your profit and loss. Operating expenses, are the types of expenses that do rise and fall depending on how busy you are, depending on how much you're selling, but they're not a one-to-one relationship with what you're selling the way cost of goods sold is. So when I think about growing tomatoes and I think about cost of goods sold, I think about a transplant, or I think about seed and everything that has to go in the tray to make those starts grow. And then I think about fertilizing the soil right where the tomatoes are being planted. And then, you know, some folks like to include direct labor in their cost of goods sold as well. So like the time you would spend like trellising, pruning, tying, weeding, perhaps. Some folks like to keep all of their labor in the main expenses category. That is the one detail where you really could go either way as long as you're consistent every single time. So operating expenses rise and fall with sales, not as directly one-to-one as like seeds and soil amendments and things of that nature. But repairs and maintenance on your equipment, you know, fuel for the truck to go to market or your tractor in the field, those are things that will ebb and flow with the level of business that you're doing, but aren't directly considered cost of goods sold. So oftentimes folks ask me questions about how do I remember where to put everything? So I recommend creating a legend for your chart of accounts because consistency is really important. Like you don't want to put one kind of purchase in one category at one point and put the same type of purchase in a different category later. That's going to, you know, negate the purpose of being so well organized. So what you can do, I'm going to scroll back for 1 second just to show you. You could take a copy of your profit and loss and your balance sheet chart of accounts just like this, throw it into an Excel sheet, put a column as far as, you know, concerning what types of items go in that category, and then just put a copy in your top desk drawer. And when you're sitting down to do your accounting paperwork, you can pull it out. The great thing about having a key also is that if someone else ends up helping you with your bookkeeping down the road, there is a guide as to trying to determine what goes where. Okay, so why does all this categorization really matter? I mean, we really do want to get to a strong understanding of our gross margin and our net profit and how we drive that information. So all of this categorization allows you a system for reviewing your reports that can be replicated for building your budget. So if you build your budget using the same chart of accounts as your profit and loss statement, then on a monthly basis, when you go to benchmark against your budget and see how you're performing, everything's in the same format. Line by line, you can see where you've met your goal, shorted your goal, overreached your goal. And it gives you consistency so that you can spot trends and see where your business might be going out of scope in expenses or underperforming in revenue or whatever it is that you need to focus on to make sure you're going to meet your goals this year. All of this organization gives you a pathway to understanding that next step. It gives you a tool for making decisions on how to spend your hard-earned revenues, and you can really see what you can change and what you can't, because the expenses that are fixed really can't be changed. If you're renting your farmland, or if you're paying for, you know, utilities, or you are paying for water, or whatever it might be, some of those things you don't have a lot of control over. But when it comes to cost of goods sold, operating expenses, general and administrative expenses, you do have quite a bit of control, and you can decide where you need to make changes to meet your overall business goals. Okay, so here's one more look at the chart of accounts, a complete listing of every account in an accounting system. So this particular one is the profit and loss. We'll talk about balance sheet a little bit later in the presentation. So you can see the categories we talked about: income, right? And then down here we have cost of goods sold and the subcategories for that. Then we see that where the calculated gross profit would be. And then we move into expenses. So we have, you know, fixed expenses here, general and administrative here, operating expenses. And then, you know, you can play with your other expenses however you would like to in your chart of accounts. This particular farm as a demo is like a business with one particular owner, and they're taking their draw and some of their personal expenses down here under other expenses at the bottom. Okay, so let's talk about the income piece, right? This is where we start at the top and work our way down. One of the things about figuring out how to do income in your chart of accounts is keeping it simple. You want to set up your income accounts in the chart based on what your income streams are, not your customers. So if you think about all of the things that your farm is doing to earn money, your brain may automatically go to the customers. Like, I'm in farmers markets, I'm in wholesale. Those are not the categories of income that you want to see in your chart of accounts. And this is the most common correction that we generally make when we start working with a farmer on bookkeeping best practices for data analysis and decision-making purposes. So in an accounting system, there are plenty of other ways to view your sales by customer. So it's not necessary to put that piece in the chart of accounts. What we really want to see is the enterprises that are going on the farm so that we can directly compare the cost of operating that enterprise with the income that comes in that enterprise. So for example, growing produce is an enterprise. Raising chickens is an enterprise. Reselling products, so products that you buy in and then resell either through like a bundled CSA box or at the farmer's market or in your retail store, whatever it might be. Those are enterprises, right? We can name a million: raising beef, raising chickens, raising lamb, raising pork, raising produce, having an orchard. So when we think about that, that's how we want to structure the income. We don't want to do farmers market 1, farmers market 2, etc. And then just a little tip about not complicating the chart of accounts. A nice way to think about it is if the total expenses in a category is less than 1% of your sales, don't create a separate account for it. Just add a memo or a description. So for example, like I've seen accounts in the chart of accounts that someone didn't know where to put it. So there's like one $30 transaction, right? That's confusing. And over time, you'll have a very long chart of accounts and things will get a little unwieldy. So you're better off, if you need to, creating like an other general and administrative in your general administrative parent category and sticking all the stuff that doesn't match somewhere in there, or figuring out if it really should be part of another category. You can always combine things with the name. Like for example, we often see dues and subscriptions. This could be dues to your membership organizations like NOFA or PASA or what have you. Or you might subscribe to Growing for Market or Modern Farmer or other publications. And it's not really enough to be 1% of your annual income in any of those categories. So you might put them together and say, you know, professional development, and have that be your dues and subscriptions and training all together. But in your key to your chart of accounts, you have that written down so you'll always know where things go. Okay, so before I talk about classes, I think this might be a good place to stop for just one moment and ask Eric if there's any questions that I should address about the 7 numbers or the income streams.
We haven't received any questions yet, so I think you're doing a darn good job explaining. But if anybody does have any questions, please feel free to use either the chat or the Q&A, and I'll either interrupt Rebecca if it's a pressing one that is on topic, or we'll handle them after she's gotten a chance to pause and get a glass of water.
Okay, perfect. Yeah, I told Eric that he's welcome to interrupt me with, you know, pressing questions that are directly related to what we're talking about. So I don't mind at all. In fact, I encourage you to ask whatever's on your mind. So another way of approaching the setup in QuickBooks is with classes. So classes are the way you want to approach it if you have a pretty complicated business. So you might have a few different kinds of income streams and also different enterprises, and you know, keeping the income streams in the chart of accounts and adding classes for enterprise can create some subsets in your profit and loss report. So as a rule of thumb, somewhere around $250,000 in sales is kind of the breaking point where things might be complicated enough that you want to start thinking about classes. If your farm is really smaller than that, you probably don't need to bother. So let me show you what classes look like. So here's an example of a farm with a collapsed profit and loss statement on the left here. So this is another good example of 7 numbers before I talk about classes. Income, COGS, calculating gross profit, and then they only needed these 4 categories of expenses. They didn't have any one-time expenses for the year. And then we see their, you know, net operating income, and then they have some other stuff at the bottom. So this farm is fairly complex, and they decided that they wanted to separate out their enterprises in classes. So now when they see their P&L, they have these columns, right? They have some kind of services that they're offering, and then grain, poultry, vegetables, and then you get the total. So if you divide up your books into classes, every single transaction needs to go into a class, or it ends up in not specified. And so there's just one more drop-down menu to play with every single time you enter a transaction. So all of that time does add up. You don't want to set up classes unnecessarily. But instead of seeing income, like services income, grain income, poultry income, vegetable income, and the cost of goods, and then cost of goods sold, same thing, services COGS, grain COGS, poultry COGS, vegetable COGS, and having those 8 lines there in the income and cost of goods sold, they're choosing to use classes, and then they see it going across the board this way. And then of course you can also look at just your total column without seeing the classes within. So it's your choice if you want to build classes or not. You need to pay for a higher level of service in QuickBooks to build the classes. If you have like the intro level, you need to move up one. But again, only really recommend this if your business is on the larger side and your books are just getting kind of unwieldy. The main thing that you want to be able to compare is the income and the cost of goods sold in any specific enterprise so that you can see that gross profit, right? Because what are we learning here? That their grain enterprise is actually contributing the most gross profit towards operating the rest of the business. And we can do this by having the lines beneath income and the lines beneath cost of goods sold. And then you need to look at them and see the gross margin for each by doing that subtraction. Or if you have it in classes, the gross profit is super clear right here. But as we can see, this is a fairly large business. Okay. So I have been talking a little bit about cost of goods sold and the assessment there. We want to make sure that each enterprise lines up the cost and the income, the direct cost of goods sold versus the income, so we can see gross margin. This is really important in understanding whether we want to keep, drop, or expand an enterprise. Oftentimes we'll start working with a farm that's multifaceted. They're doing a lot of different things. There's a retail store operation on the farm, and they're growing produce for market, and they're raising eggs, and they're maybe doing some kind of meat as well. And so in that kind of scenario, if we see that gross profit in one of these enterprises is close to 0 or negative, it's a real good indicator that it's time to make a decision about whether or not you have some personal love or attachment for that enterprise and you want to keep it in your business for personal reasons, or if it's a marketing tool or something of that nature, if there's an explanation, or if we need to figure out a cost control issue or think about actually narrowing our business focus and dropping something that's pulling money away from the other operations of business. So when tracked properly, cost of goods sold can lend great clarity and power for decision making. And so, I'm explaining a little bit now why gross profit and gross margin are so important, because it gives us that information about understanding which of our enterprises is actually generating profit for the business. And then therefore we can make decisions about where we want to expand or, where we want to focus our energy for maximum return. So let's explain this for a moment and just make sure everyone's on the same page. Income minus cost of goods sold equals gross profit. That's just the definition of that term, gross profit, that we see right here in the profit and loss statement. Gross profit divided by income gives us our gross margin. Gross margin is a percentage expression of gross profit, if you will. So gross margin can be calculated by enterprise if the chart of accounts is set up properly. So if you don't have classes, you'll just see it horizontally, and you can still calculate gross margin for each very simply, and then make some decisions about what enterprises are going to give you the results that you're looking for when you make your business plans for the year and for the future. So gross profit is just income minus COGS. It's not more complicated than that. And then gross margin tells you how your gross profit stacks up as a % of your total sales. So this particular example shows us that, gross profit can be the same in different scenarios, but gross margin can be dramatically different. So in this particular example, we're showing 2 different farms where income is 100,000 versus $500,000. And we look at the cost of goods sold with the labor included. And in this, smaller business, 100,000 with $50,000 of cost of goods sold, the gross profit is $50,000. In the second example, we see high income, but also super high cost of goods sold. And the gross profit is also $50,000. Where we can actually see the difference is what's happening in these 2 businesses is the gross margin calculation, right? This smaller income business has 50% gross margin, which is great. And this higher income business has 10% gross margin, which is not a good number. Seeing gross margin at 10% is pretty scary, just because we think about only having $50,000 left in this business to cover all of the rest of the operating expenses of the business. right? Because income, COGS, gross profit is only like the top section of the profit and loss. You still have to carry general and admin, operating, fixed, etc., with just this 10% number. So we can see the margin's vastly different here. And this is just a lesson showing you the difference between gross profit and gross margin and why gross margin matters. Okay, so we're going to talk just a little bit about the profit and loss report. And just
oh, sorry, Rebecca, I just wanted to jump in real quick with a question that we had.
Perfect.
So we had Jason asking about the tax implications of including your labor within your cost of goods sold for each individual enterprise. He said that he's heard that there was big tax implications, but wasn't sure about it. And so I wanted to see if you could speak to that concern.
So I'm not sure what the tax implication would be. I'm not a tax accountant. I am what you might call like a business analyst, right? I work with folks on trying to understand how to empower themselves to make better decisions in their business based on the data that they have. If your accounting is clear though, I don't see how it could be a tax problem because, okay, a word about accountants. They are necessary and we love the services that they bring to the table. However, they will ask you to organize the chart of accounts in a way that makes it easiest for them to do their work when they only come in once a year to help you pay your taxes. I think it's more important to have your chart of accounts built in a way that supports strong business decision making. And then if you need to spend an extra half hour prepping your taxes, I think that it's worth it. And the reason I only say a half an hour is because if your chart of accounts is well organized and all of the direct labor is in the cost of goods sold as a subcategory to cost of goods sold, right? So you have cost of goods sold and then the enterprise, right? So like produce growing cost of goods sold or chicken raising cost of goods sold, right? And then beneath those, you have subcategories. So if we look at the chicken category as an example, right? The subcategories would be feed, bedding, direct labor, right? Things of that nature that are one-to-one with the raising of the chickens, like the egg boxes or the processing if it's meat, things of that nature. If you have the direct labor in there as a subcategory of that enterprise's cost of goods sold, it would be very easy for you to add up all of the monies that you have spent on direct labor plus your non-enterprise direct payroll that's further down in your expenses and still have a total labor number for your accountant. So I don't see how that could really be a problem unless you're talking about the tax implications of having like your payroll separated out. If you're paying your payroll through QuickBooks, I would say that in that case, you just need to be very careful about how you set it up. And so in that case, if you decide to keep labor all in one category in your expenses, I think that's okay too. But you can separate things with a journal entry. So if you really want that clarity, like you use the labor bucket in your expenses, you have all your payroll running through there. And then at the end of the month, you make some journal entries to move some labor numbers up into cost of goods sold where they should be based on the usage. And then you have more clarity and you still have a streamlined process. I hope that answers the question. I gave you a couple options there as to how to handle it.
We had one other question that I think might be good to tackle now from Jamie Silverstein saying, in the gross margin example, are you hypothetically comparing across enterprises? If so, would you calculate the gross margin by dividing by total income across all enterprises as opposed to dividing just by the enterprise's income?
It's a good question. Let me scroll back for a second. Okay, so in these categories here, we see this is an example by classes, right? You could do the same thing if you just have the vertical set up here or horizontal set up here on the left. So if I want to calculate my gross margin by enterprise, I would divide by the income of that enterprise. But what we really want to look at is as a total, you want to look at it both ways, basically. But yeah, you want to divide by the total as well. So I think there's some value in seeing what the margin is for, each enterprise. You need to see that, but then you still want to see your gross profit as a percent of sales for the whole thing. So you're gonna play with your numbers in a number of different ways. This is the structure that it's gonna allow you to have a number of different permutations of metrics coming out of here. So let's walk through the profit and loss report and then let's take some more questions, but I want to make sure we have time to get to the balance sheet too, if that's okay. Okay, so the profit and loss is the report that you're going to look at most frequently. It's the history of your income and expenses categorized line by line. So you're grouping them up so that you can get some accurate reports. We talked a little bit about the balance sheet as far as something we're going to talk about today as well, but that's where assets and liabilities go, such as properties and loans. So one of the most deceiving things about an income statement for a business owner is just understanding what does and does not appear on there. So if you are paying down a loan, like a mortgage or an auto loan or just an operating loan, those loans are going to live on your balance sheet. So the cash that is leaving your business to pay those monthly loan payments does not appear on your income statement. Only the interest portion does, not the principal portion. So if you look at your net profit on your profit and loss statement, that is not your cash position. Okay, so it's just important to remember that and think about what are the outflows that are going to pay your loans and other liabilities, because they will not appear on your income statement, profit and loss, which are synonyms. I don't think I mentioned that yet. Income statement and profit and loss are the same thing. So what are we trying to understand with this report? Comparisons showing changes, which create questions around income and expenses. You want to come to some conclusions so that you can take action based on what you're reading, and then you can look at some key ratios, which is the answer to Jamie's question, right? There are a number of key ratios we're going to look at, including gross margin and percent of sales. So let's look at some profit and loss comparisons and then take a couple more questions. So here's an example of our East Bend Farm account. We have 3 months of the profit and loss. So this would be like the kind of analysis you might do at the end of the first quarter. We're looking month by month, and we can see how our income might change from month to month. We can see how our cost of goods sold might change from month to month, et cetera, all of our expenses. So if you have a budget that you're comparing to, you can see which of your months are in or out of scope with your budget, or if you had a month that didn't perform as expected. It also helps just looking at the total versus the breakdown of each month to understand how different expenses are being controlled or moving along. I mean, just as an example of control, like your fixed expenses, you're not going to have much control over. You got to make those insurance payments. You have to pay the interest on your loans. But when it comes down to, some of your operating expenses or even some of your discretionary general administrative expenses, that's where you have control to change your budget and how things are going to turn out in the end. We look at our gross profit here. So we can see, for example, 2 months in the black and then 1 month in the red, right? So March is not a high performing month for this particular business. And then when we look at the total net operating income, we can see that we're still positive for the quarter, but boy, do we have a lot of overhead expenses going on in March to get ready for the next season, but we're not really earning any income yet. So this type of comparison will help you budget and plan for your business, right? If you have a monthly budget in the same format of your chart of accounts, not only can you benchmark against it, but you can see where you're going to experience a cash shortfall during the year, and then you can make better decisions about getting ahead of that. Do I want to acquire a credit card? Do I want to get a line of credit from my local bank? Can I float my cash shortage with the cash I have in the bank from last year's business? These are the questions that you can answer ahead of time. No one wants to give you a loan in the moment that you're desperate. So these are good lender documents as well for getting ahead of the game. Before we move on to the balance sheet report and understanding what your business is worth, Eric, do we want to take a couple more questions about the P&L?
We haven't seen any questions come in for right now, so I think we can probably push forward and then see if anything comes up by the end.
Okay, thank you. I will say that we have a document, like a one-pager for standardizing your chart of accounts. And when we share the recording of this webinar later, we can also share that one-page guide as well. All right, so the balance sheet report is about understanding what your business is worth. So why is it important, right? We always want to talk about why something's important before we talk about how to do it, right? Is it worth our time? Do we need to do this? So the balance sheet will help you identify your net worth, your equity in the business, how much is left in your business, and what's left for you if you wanted to sell the business. It's also a really good lender report, as I said. So it shows what your business is worth and how you can justify the possibility of handling some new debt. So the goal, when we think about our income statement, the goal is pretty easy. We want to build something that comes out profitable and pays us a living wage or a salary that we're happy with as a business owner. The balance sheet is a little bit less intuitive. The goal is to increase the equity of the business over time, have the business grow in value over time. So what goes on the balance sheet? Your loans and lines of credit. The interest is going to be reported as you pay it on your income statement. The principal hits the balance sheet. So that means a split 2-line transaction every time you pay a statement on a loan or a mortgage or something like that. We have assets. Some of them depreciate and some of them appreciate. What kind of assets might appreciate, right? That's kind of confusing when we think about it, but like the value of an animal would appreciate over time, right? So the value of like a calf versus like a head of beef ready to go for slaughter would be more valuable than the calf, obviously. Whereas like your tractor is probably just going to depreciate. So we have liabilities that are associated with each of our assets usually. For example, land versus mortgage, equipment versus the equipment loan. So anytime we have a liability or like a note that we have to pay, we also have a corresponding asset, and we get to put the value of that asset on our books when we also put the liability on our books as well. So total net worth of the company is calculated by assets minus liabilities. So the total number in your equity can be negative. We've seen that sometimes. So the other way people look at this equation is assets equals liability plus equity. Here's a snapshot of a balance sheet report from also like a demonstration farm that we have in QuickBooks. So this provides a snapshot of assets and liabilities and also an understanding of how you would need to build the chart of accounts for your balance sheet. So keeping in mind, the chart of accounts is simply a list of categories or buckets that different expenses and income go in, and also assets and liability and equity. So when we look at this balance sheet example, assets include the bank accounts, the accounts receivable, and any current assets. Also fixed assets, right? So machinery and equipment. And accumulated depreciation comes onto your balance sheet as well. Like we put depreciation on the income statement every year, but there's accumulated depreciation here from assets losing their value. And then under liabilities, we have all of the different credit cards and loan accounts. And then we also have the equity accounts. So when you have net profit at the end of the year that does not get distributed, it moves onto your balance sheet under your equity each year. So if you're keeping if you're keeping net income in the bank, your retained earnings will increase over time. And then you can also see like, opening balance of equity or paid in capital over the course of the years. So when we have an accounting system that we're using as a tool that we need to keep sharp and ready to roll for decision-making purposes, we need to stay up to date. One of the bigger challenges around bookkeeping in a small business is staying up to date, right? Like making that time, making that ritual once a week where you sit down and you do your banking feed and any receipts that are sitting in your wallet, and you track your income from all of the different selling activities that you did for the week. And you get it all in there. And if you stay up to date with it, it's a much more efficient process because you're not really fishing around trying to figure out where things go. You're so familiar, you're doing it all the time. There's a system, a standard operating procedure, maybe even a checklist if you're well organized with the things that you need to do to finish out your books for each and every week and then move forward to the next week. At the end of the month, you want to reconcile your accounts. What does that mean and why does it help you? Let's talk about that for a minute, because without reconciling, none of these reports will work. Okay. So we recommend that we always reconcile on the 10th day of every month. By that point, all of your credit card and bank statements should have dropped. You should be able to make copies of them, like grab any receipts from employees that you might need, and go ahead and get started. So usually, in your accounting software, you have your banking feed turned on for your credit cards and payment accounts. You want to gather up all of your monthly statements for all of the accounts that you have, and go ahead and sit down and reconcile your accounts. So what does that mean exactly? You clear your transactions out of your banking feed in the register by saying which account they belong in. So you can add account or match it or make a transfer if you're moving funds from one account to another. Or if you don't have any automatic electronic feed coming in, your bank doesn't support it or you've chosen not to turn it on for some reason, you would just enter your transactions in from your monthly statement that you may have missed over the course of the month. And then when you actually hit the reconcile button, it presents you with everything that you've put in the system for the month. You just look at your statement, grab a highlighter, check each box to verify each transaction. And as you do that, I recommend you highlight on your statement. And then if there are any unhighlighted transactions on your statement, you know you're still missing one. Or if you have something that's in your reconciliation feed that's not on the statement, then you know someone's like sitting on a check and you have to wait till next month to check that box. So ideally you want to do this weekly for each of your accounts, or you can do it at the end of the month. It's just a matter of volume. If you have a lot of transactions, weekly is going to serve you better. So at this point, you're basically ready to reconcile. There are a couple things that often go wrong when you're reconciling, and this little puppy over here kind of explains how you might feel if you're having a lot of errors in your feed, because it can be really frustrating. So a couple things to look out for is that you made a mistake when you accepted the transaction as either an add, a match, or a transfer. So like if you added something from the banking feed that you had already entered, instead of matching it, you may have it in there twice. Or if you moved money from one account to another and you added it, instead of making it a transfer, it won't appear on both accounts. It'll only appear on the one where you added it. So those are some sort of pitfalls you want to avoid. Duplicates, issues with transactions that were already reconciled that you then modified. You don't want to actually modify anything that's already been reconciled. You'll notice a little R next to it in the register if it's already reconciled. Or, you know, if you're putting things in and you're not doing it by the correct date, it can also be frustrating, right? You want to put transactions in with their statement date, not with the date that you're sitting down at the computer, because that could really throw things off. Okay, so here's what reconciliation looks like in QuickBooks. I'm going to show you that. Okay, Eric will let me know if for some reason you can't see my QuickBooks screen, but you should be able to. So
You're all good.
Thank you. When you go to reconcile, you go to your banking screen and you go to a register. And my Zoom window is in the way, so I'm going to move it. But you hit this reconcile button. People get kind of scared of this button, but it's not scary. Okay, so all reconciling is coming down through this feed and checking the boxes on the right-hand side to verify the transaction. When you go to reconcile, it'll prompt you for a beginning and ending balance. You really just want to make sure that your balance at the end of the month matches what you have in QuickBooks. And once you have a clean balance match, you know you got everything included. And that goes across all of your accounts. So I have worked with plenty of farms that have never used the reconciliation screen, which scares me a little bit, because then you have to go back over a long period of time and reconcile to get caught up, or just accept a reconciliation discrepancy. Or the other thing I was talking about, just to show you, is in your banking feed, we can see options to add or transfer or match a transaction. So it's just important to get these put into the right category. So QuickBooks is always going to make suggestions because it's a piece of software trying to be smart and make your job easier. But some folks don't know you can actually click on these lines. And then if you need to make a change to the vendor, or try to find a match because you're so sure you entered that transaction already, you know, you have options to do that in this banking feed here. And I know it can seem a little bit scary. The other thing I just want to quickly show you is chart of accounts in the settings wheel here. This is the screen where all of the accounts are built. The screen to me is also like the least intuitive place to analyze your chart of accounts, because this is a laundry list of numbers. This is exactly what our brains want to avoid. That's why we suggest the 7-number system. So when we look down first, we see all of the asset accounts, and we see the liability accounts, and then we see income, cost of goods sold, all of that going down. So one of the things that we want to point out is, first of all, the indentations are how you see sub-accounts. But second of all, you know, you may be better off if you have enough data in your system just looking at these in the profit and loss statement or in the balance sheet statement, just to see how things get laid out. And then you can come back in here and make changes as well. The other example I wanted to point out is here under cost of goods sold. You can see we have our enterprises, but then we can even have subcategories within, right? So this is a category, this is a subcategory, and then these are subcategories. You can go as deep as you want in that hierarchy, as long as the high level 7 numbers that we're seeing allow us to make some judgments about the business. I'm going to quickly show you in reports how to actualize what we're talking about. So if I pull a profit and loss statement, I'm actually going to do this for a prior year. I believe that we built this a long time ago, and a lot of the data that I want to show you, I think, is in 17. So let me try that one. It might be 16. You choose a custom date range if you want a prior year. Then you can run a report. And so we can directly compare the income versus the cost of goods sold, right? For example, farm grown products, this amount of income versus this amount of cost of goods sold. So we can see we're running at close to 50%. And then resale products, we can see, you know, we're not performing as well. We sold about $18,000 of resale products. And then we have, you know, almost $10,000 here in cost of goods sold. So we can see that we might want to figure out how we can move the needle a little bit for a better cost of goods sold in our resale product. These are the kinds of inferences we can make from just looking at the statement. But one other thing that, you know, you can do here is just add some comparisons if you want to compare a previous year or previous period. And then you can also add, you know, percent of income in here if you want to see that as well, which is a really nice feature to be able to add if you weren't aware that that was there. So I'm going to leave QuickBooks and go back to my presentation here. So if you're in this webinar today and you want to know what to do next, this would be the homework that I would recommend around your chart of accounts. I would print a copy of your P&L and your balance sheet, and I would also print a copy of your chart of accounts ledger, because the thing about QuickBooks is that if you have a 0 value in that account for the year, it's not going to show up in your statement. So you just want to see what else you have in there that might be left out. I would create a spreadsheet to restructure your chart of accounts with all of the indentations that you would see for sub-accounts in your profit and loss and balance sheet, and see what it would really look like with everything that you have in there. You want to reconcile your accounts so that you have a clean starting point. Maybe, you know, maybe you want to just batch reconcile everything to the beginning of the year and then carefully reconcile this year if your taxes for last year are done already. And then you can generate reports like the one that I showed you. And then the next step, like the advanced level of working with your chart of accounts, is to use that profit and loss statement from last year, maybe month by month, and get ready to build a budget out of it. I'll show you 2 more little tricks in QuickBooks here that I think are important as we're looking at this. So we talk about the 7 numbers, but you're probably wondering why we're still looking at such a long list of numbers, right? The question might be like, Rebecca, this isn't exactly what you just talked about, but it is. So I'm going to show you this great button here called Collapse. Okay. So now we have the income, the cost of goods sold, the different categories of expenses, and then, you know, as an owner, you can do whatever you want with your other expenses of how, if you, that's where you want to show your draw. If you don't put it in labor, you can put it down there. So we can clearly see like each of these expense categories as a percent of sales, where they stand, and how we're looking in gross profit. And then we can open up our income and cost of goods sold categories, and in an export to Excel, do some of those side calculations on the gross margin for each of those categories. So this expand and collapse button will serve you well. If you want to see something in greater detail, excuse me, let me collapse it again. You can always just open it here on the side too. You know, you don't need to go back and expand the entire thing. Or you can do that and then collapse down what kind of detail you may not want to see in that particular moment in time. So expand and collapse is important. And then the other thing, if you're not aware, you can show by month. So if you do run the report by month, this then becomes, I'm going to take that percent of income out of there because it's just making it a little messy. Now we have a really great template for building our budget for the following year. So what you could do is export this to Excel, think about all of the changes that you're going to make in your business, reforecast your income, reforecast your cost of goods sold, and then use this as a template for your budget and consider how each of the expenses would change line by line. We also teach how to build a budget. That's a whole other couple of hours, but just for knowing where this is going and where this is getting you to and how to get started with the next thing. If you're an Excel junkie and you like working with your numbers, you could certainly take this to the next level and use this format to build your budget for the following year. So with that, that concludes my presentation for today on chart of accounts. I'm happy to stick around for a few more minutes and answer any questions. If you're reviewing this webinar at a later time and you have questions, you're always welcome to call, text, or email me, and I'm happy to talk to people about how these things work out for you when you start putting them to use in your business and in the real world, not just in a 1-hour webinar of taking in the high-level version. And I really appreciate all your time and attention today. It's my pleasure to be here and present to you and with GrowNYC. And we really do hope to hear from you and how you start to implement some of these tools and next steps.
Does anyone have any questions? I was going to ask, just from your experience working with a variety of different farms, both in wholesale and direct to consumer, what do you usually see as kind of like benchmark numbers for when a different type of farm is actually set up to be successful and make sure that they're covering all their overall like fixed incomes and such? Like, I know that that's a very specific question, but like I know in our crop costing tool, we always have been using 20% and 40% as the net profit margin percentage that we were going for, and I was just curious what your
20% gross profit for wholesale and 40% gross profit for retail.
Yeah, sorry.
So let me say something about that, because that is a benchmark number that we put out there when we were pressed for people asking us, like, what's the absolute lowest you should go? So let me put that caveat on there, right? Because there are plenty of opportunities, and I've seen plenty of cases where the gross profit on crops or what have you are certainly higher than 40%. And same with wholesale being higher than 20%. I think, when we answered that question for folks, it was like, when am I in the danger zone? And it was kind of like, don't cross that line. But I don't necessarily feel like that's a great goal to reach for, because I think that it puts you in a position where you're, working with sort of like so just, I think setting up your business to aim for a 20% gross profit is not a great strategy. I think you want to be higher than that. But I think if wholesale is a portion of your business, that's the lowest you would want to go on margin for a particular crop. But to answer your question, it really depends on the business. And I don't want to generalize, but like when we look at what's going on in the world of sustainable proteins, like we tend to see some smaller margins in proteins. But again, it depends on like your processing and, what all of the size of your farm and the scenario around your production. I don't think I can answer that question. I mean, I think that aiming for 50% cost of goods sold is a good benchmark, but I mean, not every farm is going to fit that mold. And when you look at building a budget for net profit, when you get to that bottom line of net profit with all of your salaries and everything rolled in, if you're seeing a net profit number that's higher than 20%, you probably forgot something, or there's something not realistic about the plan that you've built, whether that's like the pricing that you intend to receive as revenue, or like maybe a big underestimation of logistical expenses or something of that nature. But, I think 15% net profit is probably a pretty healthy and realistic goal for production businesses as I've seen it. So Other of my colleagues may have different feedback on that, but you know, most of the time, if we see budgets built with net profit in excess of 20%, they don't come to fruition.
Gotcha. What would you say is like the best tip you could give a farmer in terms of trying to make sure that they're actually reconciling on a consistent basis? And like once they've done all the homework that you've given, you know, have you seen any farms who just have a really great way of staying on top of it so that they can better assess their profitability consistently throughout the year?
I do. And I mean, you know, I get the pleasure of working with farms for 6 months to a year to teach them these skills and then, you know, set them free to go and do it on their own and come back to me if they need a little help or support. But those that are successful are those that carve out a standard operating procedures document for their bookkeeping practices, right? Like if you were bringing a farm manager onto your farm and you had a process by which like you grow your super awesome fill in the blank, tomatoes, salad mix, whatever it is, you have a process on your farm for how you plant, how you transplant, how you seed, how you harvest, do you lay plastic, do you not? Like all of these things are the standard operating procedures of how you care for a particular crop. And if you have a star crop on your farm, I guarantee you would never let it get to be such a mess that like the weeds are all over it and you walk down that row and it doesn't look good. You need to take that same attitude to your bookkeeping to be successful. And that's the best tip that I have. Like minding the weeds in your bookkeeping is just as important as in the field and having a process. So if you have a checklist and you stand by that checklist, you will be in great shape. Every Friday at 10 a.m., I come off the field and go into my office for 90 minutes with a cup of coffee and my favorite snack, because, you know, sometimes reconciling sucks. So it's nice to have a snack. So you're going to sit down at your computer with those things that are going to keep you on task and engaged, your music, whatever it is. And you're going to go through the steps of your checklist. You're going to enter all of your sales. You're going to check against your point of sale system square or whatever for like refunds and any blips and issues. You're going to enter all of your receipts. You're going to manage the banking feed. You're going to check against any of your payment systems or CSA management systems or whatever other integrations you have that are going to feed the data into your bookkeeping system. And then, you know, that 10th of the month thing is real, like setting that time on your calendar. If you're busy on the day that month, you have to move it by a day or two, but get that time on your calendar so that you have that 2-hour window to sit down and do reconciliation once a month with all of your accounts. The other thing that is the biggest tip for success, though, is that if you're still mingling your personal and your business accounts, you will find this task impossible. So a lot of times when I start working with farmers, the very first thing that they need to do is go open another checking account at the bank and keep their personal stuff out of it and separate. Because if you're excluding transactions from a feed, then when you go to compare against the statement, there's gaps. And so you never know when you're just quite right. And your balances can't match that way either. So you should have a credit card that's just for the business, not personal. And you should have a bank account that's just for the business and not personal. And then that will lead you down a path of being able to stay organized and cleaned up. So there is not just one tip. I think that was 3 tips. It was separate the accounts, set a weekly time to settle in and don't skip it, and then set that monthly time for reconciliation and find a way to keep yourself motivated, because let's face it, reconciliation is not exciting. I mean, unless you love being a detective and finding that one transaction that's missing, it's not exciting, but it's necessary to understand exactly what's going on in the business, close out the month, and move forward with progress.
Great. Well, thank you very much for spending the time with all of us and teaching us all your ways of making sure that the farm's staying profitable. And I do want to just do another shout out to the free 4 hours of consulting work we have, well, an hour per 4 farms. So if anybody's interested in working with Rebecca or myself in the future, please reach out to us. You can see Rebecca's contact information there. I emailed everyone this morning as well, and we'll be reaching back out to everyone with recording of the webinar, as well as a few other, as well as the presentation. Yeah, I hope everyone has a good day, and thank you again, Rebecca, for all your help.
You bet. Thanks for attending, everyone. Have a great day.
Bye.